Welcome. First, we'll frame the 25% savings rule and ask whether it truly leads to a worry-free life. Then, we'll explore how investment discipline, spending control, and flexible assumptions make or break the outcome. Stay with me as we move from big ideas to practical steps. Here's the roadmap. First, we'll define the 25% rule and who benefits most. Next, we will break down coast fire. We'll surface hidden risks and build a tax-advantaged contribution order. After that, we'll walk through an action plan, test your knowledge, and close with key takeaways. Let's start with the big idea. Saving 25% of gross income can be powerful when you invest steadily and keep spending contained. However, no single metric guarantees a worry-free future. Therefore, we must pair saving with spending discipline and realistic assumptions. Now let's clarify what 25% really means in practice. Next, let's translate 25% into daily decisions. Treat 25% as a floor, not a guarantee. It works best for people who keep costs low and invest early and consistently. Cash does not compound, so avoid leaving savings idle. Build an emergency fund first, ideally 6 to 12 months of expenses, with 10 to 12 months being excellent. Finally, maintain vigilance against lifestyle creep by keeping fixed costs lean as your income rises. Now let's see how these pieces flow into coast fire. Moving on, here's the flow from paycheck to coast fire. First, adopt a simple budget structure such as 50% needs, 25% wants, and 25% saving and investing. Then, automate the 25% transfer so saving occurs before spending. Next, prioritize tax-advantaged accounts and invest in low-cost diversified index funds. Finally, let compounding work over time and avoid reacting to short-term volatility. Now let's define coast fire more precisely. Now, let's clarify coast fire. Coast fire is when your invested balance is large enough that, with reasonable long-term returns, it can grow to cover retirement needs without heavy future contributions. The key is aggressive early saving and investing. Your coast number depends on realistic assumptions about spending, inflation, and returns. With that foundation set, let's separate myth from mastery. In contrast to common myths, mastery means viewing 25% as a strong floor, not a guarantee. It also means assuming inflation and housing may be higher than hoped, investing consistently rather than sitting in cash, and actively managing future spending. With that lens, let's address the biggest risks. Next, we confront real risks. Lifestyle creep raises fixed costs and crowds out saving. Expecting sub-$200,000 homes in 10 years may be unrealistic in many markets. Return assumptions can be overly optimistic, so plan for ranges. Do not ignore taxes, insurance, healthcare, and maintenance. Finally, avoid abandoning the plan during market swings. Now, to strengthen your path, let's structure your tax-advantaged order. Here is a typical contribution order. First, capture the full employer match because it is effectively free money. Second, contribute to an HSA if eligible due to its triple tax advantage. Third, fund an IRA, Roth or traditional depending on eligibility and tax strategy. Fourth, finish maxing the employer plan. Finally, invest in a taxable brokerage account for flexibility. Limits change annually, so verify current year limits. Now, let's convert this into concrete steps. Now let's operationalize it. Write a one-page investment policy outlining accounts, savings rate, asset allocation, and rebalancing. Automate transfers on payday to pay yourself first. Follow the tax-advantaged priority order. Choose low-cost index funds and control fees. Use retirement calculators with conservative ranges. Revisit housing expectations and include buffers. Direct raises toward investments to avoid lifestyle creep. Finally, stay the course and rebalance on a set schedule. Up next, a quick question to test your understanding. Quiz time. If your employer offers a 50% match up to 6% of your salary, what should you generally prioritize first? Option A. Max a Roth IRA before contributing to the employer plan. Option B. Contribute 6% to get the full employer match, then fund the Roth IRA. Option C. Hold cash and wait for a market dip to invest. Option D. Pay extra on a 0% interest loan before investing. You may pause the video now to think about the answer.
We will discuss the answer in the next section of the video.
The correct answer is to contribute 6% to get the full employer match, then fund the Roth IRA. The employer match is an immediate, risk-free return, and the Roth IRA offers valuable tax characteristics.
Next, let's talk about discipline and emotions in volatile markets.
Next, discipline beats emotion. Follow your written plan rather than chasing recent winners. Rebalance on a predefined schedule. Remember that volatility is normal, and the long-term return compensates you for staying invested. Now let's run through a quick markdown-based example to make the math concrete. Now here is a compact markdown playbook. The savings rate equals total annual savings divided by gross income. For example, with an $80,000 income, a 25% target is $20,000 per year, about $1,667 per month. Prioritize the employer match, then the Roth IRA, then finish the employer plan, and finally, taxable. For stress testing, compare base assumptions to lower return and higher housing scenarios, and adjust timeline or spending accordingly. Next, a flexibility map to visualize your levers. Moving on, here's a flexibility map. You can control spending, increase income, improve investment efficiency, and time large purchases. Then assumptions shift. Adjust these levers rather than abandoning the plan.
Now, let's test your understanding with a second question. Second quiz. Which statement best reflects a realistic approach to future housing costs? Option A. Plan to buy a livable home for under $200,000 in 10 years regardless of market trends. Option B. Assume housing will track inflation exactly with no buffer. Option C. Build flexibility by considering higher prices, targeting a larger down payment, and remaining open to location or property type changes. Option D. Avoid saving for housing and rely on future raises. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to build flexibility by considering higher future prices, setting larger down payment targets, and staying open to location or property type changes. Housing markets are local and can outpace general inflation, so buffers reduce risk. Next, let's add a concise disclaimer to keep everything in perspective.
Disclaimer. This video is educational and not financial, tax, or legal advice. Verify current year contribution limits and account rules,
and consider consulting a fiduciary advisor for your specific situation. With that in mind, let's crystallize the key points. Here are the key takeaways. Treat 25% as a powerful floor and make sure it is invested. Control future spending to avoid lifestyle creeps. Maximize tax-advantaged accounts in a sensible order. Use realistic assumptions for housing and returns. Finally, stay disciplined by automating, rebalancing, and reviewing annually. Next, a brief summary to wrap up.
To summarize, start now by automating 25% and investing consistently. Model your cost number with conservative assumptions. Revisit housing plans and add buffers. Guard against lifestyle creep and track fixed costs. Review your plan annually and adjust specific levers while maintaining discipline. Finally, let's close with a quick thank you and a call to action. Thank you for watching. If this was useful, please like the video, share it with a friend, and subscribe for more content. I would love to hear your perspective on the 25% rule. So share your thoughts in the comments.